Okay, so in this episode, I want to describe to you how the mortgage interest rate affects your monthly payment and why the mortgage interest rate may be a greater factor in buying a home compared to the price. And I'm going to show you how paying a higher price for a home at a lower interest rate may be better than waiting for home prices to drop and then uh, purchasing a home at a higher mortgage interest rate. So I will leave a chart in the show notes that shows what I'm about to describe. For those of you that are watching, I'm going to share my screen so you can see this as I speak about it. But there are two scenarios that I've laid out. One is the purchase of a home at $300,000 versus waiting for home prices to improve and to go down, and purchasing that same home some time in the future when prices go down for $265,000, which is a savings of $35,000 off the price, which is pretty significant. It's about a 12 or 13% decrease in price from 300,000 to 265,000. Well, today's interest rate, if you can get a 30-year fixed mortgage for 2.8%, and that would give you a monthly payment of just over $1,200. $1,232 would be your monthly payment. And then in addition to that, just full disclosure, you really want to do your homework and talk to a lender, find out precisely what your monthly payment will be with other things included, including insurance and taxes. So I'm not including insurance and taxes in the monthly payment. I'm just purely going by the principal and the interest payment. So your monthly payment would be $1,232 for this $300,000 house that you feel maybe is overpriced and you're waiting for the prices to drop. So let's say you wait a year and prices do drop and you're able to then purchase this home for $265,000. But meanwhile, the interest rate has gone up to 4%, which is not unreasonable to assume that, first of all, interest rates will go up because they really can't get any lower. But the interest rates will be going up. And I've seen estimates as high as over 5% in the next year or two. So I'm being conservative and saying it only goes up to 4%, which is still a very good rate historically for interest mortgage rates. But it's 1.2% higher than the interest that you could get now at 2.8%. And so your monthly payment, though, on a $265,000 mortgage at 4% is $1,265, which is actually $33 more per month than if you would have purchased a house at $300,000 at a lower interest rate. And so the total interest paid over 30 years is actually $71,000 more at 4% than at 2.8%. That is 4% purchasing the home for $35,000 less. So if you feel you're overpaying now, that you don't want to pay $300,000 for this house, you're waiting for prices to drop. Okay, wait, the interest rates will be up. Your payment will be higher than it would be today if you just made the purchase by $33 a month. And then the total interest payment, like I said, is $71,000 more at 4% than it is at 2.8% with that price difference. And so over the 30 years where you pay interest, your total payment, your total cost for the loan with the purchase of the house and the loan costs is about almost $12,000 more, a greater loan cost by having a 4% mortgage at $265,000 at 4% interest. So I hope that you can see and understand the point that I'm making is, is that holding out for prices to go down when it's most likely will be in conjunction with interest rates going up does not make sense. Now, if the price difference is so, slim, it will make a difference. Maybe it is worth waiting for it to drop $10,000 and you'll pay, an extra 0.5% interest. So in a scenario like that, but that may be a break even scenario actually. So anyway, I wanted to just bring this message to you because a lot of people only focus on home prices, but the cost of money is extremely important. And the interest rates and your monthly payment, being able to lock into a monthly payment that you can afford, that makes sense, and in many cases is less than what it would cost you to rent a home if you're going to be in the home 5 years or longer. It makes sense to go ahead and pull the trigger, pay today's prices. Interest rates will go up. If your home value goes down, you're locked into what your monthly payment will be. And then over the long haul, over 5, 10, 15 years, your home value will most likely go up to more than what you paid for it in the beginning. So anyway, if you have any questions about that, or you want to access the chart where I have this laid out in a graphic spreadsheet format with these numbers, the $300,000 purchase at 2.8% versus a $265,000 purchase at 4%, you can access these show notes at innovativeproperties.com and just click on the link that says podcast, and you'll be able to get and download this chart.